A lot of people don't realize there's a different types of REITs. There's equity REITs, which is the traditional REIT, and then there's debt REITs, which are most commonly called mortgage REITs. And there's really not that much distinction when you read about a REIT. If you're just reading the high level, IIPR is an equity REIT. And there are other publicly listed debt funds that are mortgage REITs that are publicly traded. And so they don't say mortgage REIT, they just say REIT. And so I think that a lot of retail investors may or may not have realized that there's a distinction between how those investments work. An equity REIT owns the property, whereas a mortgage REIT is just investing in the mortgages that lent to the property owners. And so there's a big distinction of that model and the risk profile for those. There's no equity protection in the equity REIT, but they own the property free and clear. The equity REITs, they get the depreciation and they get some other benefits. Equity REITs, if there was an increase in the value of that property, those equity REIT investors get that benefit, which in traditional equity REITs, you're invested in it a long enough time, almost all property appreciates over time. Conversely, though, if there was a property value to go down, it would go down as well in an equity REIT. But the mortgage REIT can be paid off at any time as the capital costs come down and they can get into a better mortgage rate. You have the protective equity. So the value of the property may go up and down somewhat, but you still have that protective equity cushion that the borrower put up. And so that's a massive difference, because in the cannabis sector, there is no comps for any fully mature market that's fully stabilized to really assess what the true value of those properties are going to be over a long period of time. And so for us, the way we think about it, we look at replacement cost value for that real estate, and that's how we lend off of it. And we figure that within the 2 to 5 year loan terms, that you're not going to get too far out of that perspective of what that value of that property is. And even if you did, we have the personal and corporate guarantees to come back on if there was a shortfall there. Whereas opposed to the equity REITs, those values over the next couple of decades, let's assume that they go up, but who knows what the market will be in 10, 20 years. Can you cross state lines? And if you can cross state lines, will that property that was in a less favorable tax area and labor cost market and power be as valuable as it once was 10 years ago? And so these are the things that we try to think about when we're underwriting these transactions, is what's going to happen if and when legislation passes that would change the landscape out there. I think it's important to know that a lot of people think that there is no institutional investors in this sector, and that's untrue. IIPR, for one, has 72% of their investors are institutional investors. They are fortunate to be on the New York Stock Exchange. And there are some other equity REITs that are mortgage REITs that are on the NASDAQ, and they have institutional investors participating in them as well. Now, we're private, so we're not on any major exchanges, but we were able to access institutional type investors. And when we did our bond offering, and we're working on things that are laying the path through for institutional investors to start investing into this asset class as well.